Sandeep Bhatia, Executive Director and Head of Sales with Kotak Institutional Equities, joins us live. Sandeep, fantastic to have you back. Thank you for joining us. Sandeep, why are we staring at such a fractured or a divided market? Good quality stocks are getting expensive, value stocks are only getting cheaper. The logic here is that markets are hunting for safety stocks, but safety stocks are now available at wild P multiples.
So that's not a healthy market, right? I mean, it's a two-track market where the safety stocks are all ranging from 20 times to 40 times. So clearly, market is in a feverish mode as far as the safe stocks are concerned, and in a completely dead and downbeat mode as far as the rest of the economy is concerned. So it's not a healthy market. It's not a market that one should feel happy about. It's just the way things have panned out. It's the sheer lack of any confidence in any announcements by the government which can revive the economy, or any hope that until the elections are out of the way and we have a stable functioning government in place, that anything can happen as far as growth is concerned. So whatever money you have, park it in the stocks which are not going to blow up, who have decent managements, have stable cash flows, and don't have stretched balance sheets. That's what's happening.
But why are fund managers or money managers happy to pay so much of premium? If stocks like HUL, ITC or Nestle are moving up, they are only moving up because of institutional activity. Traders don't have the muscle to take these stocks up. So if smart guys are ready to buy into HUL, ITC or Nestle, what does that mean?
Well, I think it's incorrect to say that people are happy to pay these multiples, and people are thinking that this is going to generate extraordinary kind of earnings growth. What people are doing is just protecting capital. And if they have to pay a premium for protecting capital, that's better than losing capital, and they are taking that call. The real issue is that we are in such a situation, but instead of generating wealth, we are just looking at wealth protection, which is what this market is telling you. So, I don't think we can assume that people are, happy or smart money is going there, and these are just labels. So the fact is that everyone's helpless. And everyone is just basically trying to save capital, protect capital, and that's why the market is behaving the way it is. It's not a sustainable experience. Would you think that for the next 3 years or 4 years these stocks will do well despite the real economy not improving? Of course not. Everyone knows that eventually reality catches up. The only thing that people are hoping that the reality will change before that, and therefore they'll get a smooth exit. I really doubt that once you overpay and raise premiums to such high levels, you actually end up having a safe and a smooth exit. But that's a problem of the future. Right now we are trying to solve the problem of the current problems, and which is why we are hiding here.
Sandeep, what's happening with the entire FMCG space? I mean, fair enough, Unilever is seeing the FTSE MSCI rebalance adjustment, but what about the rest of the space?
Well, the rest of the space is just I think if you look at the composition of the Nifty, there are 9 stocks which are like 47% of the total index weight. So these are the stocks which are the pharma stocks or Reliance or FMCG. All these together, Sun, Cipla, all these kind of stocks are holding up the indices, and other than that, it's just carnage. So, I mean, I don't think that there's much more than the fact that we have to hide somewhere, and which is what is happening, and we cannot actually even impute any kind of logical reasoning to it. It is driven just by a desire to seek safety.
Right, let's look at banks. And IndusInd Bank, Yes Bank and ING Vysya Bank. These are 3 banks which have managed to stabilize. But bear in mind, IndusInd Bank, Yes Bank, even for that matter, ICICI Bank, they've lost about 8–10% in a matter of just 2 trading sessions. Sandeep, do you think one should use the current decline in private banks to their advantage to load up more? Because irrespective of a tough environment, these banks have managed to grow. Last 2 years have been extremely sticky for Indian economy, but banks like IndusInd Bank, HDFC Bank or Yes Bank, they've managed to grow. So one would imagine that they will continue to grow.
Okay, a couple of factors that need to be understood. This is a sharp movement in the last couple of trading sessions, as you correctly pointed out. Is this going to be short-lived, or is this going to take some more time for the trade to come through? I would be in the camp that we will have high interest rates at least for the next 3 to 6 months, possibly around 6 months that the rates have to be higher. The impact on that on any bank balance sheet or any non-banking financial company, any NBFC which is borrowing on the wholesale market will definitely come through in terms of margins. It's a bit early to say that some of these high-quality private sector banks should now be bought. I think we would want to see whether this is going to be a 6-month phenomena or even longer. I hope it is not longer than that. But as far as the market is concerned, I would want some of these private sector banks to reflect that in earnings. So I would probably wait for around next quarter's earnings before taking a call whether this is the right time to buy or not. So I think these businesses will remain under pressure for some more time until we see clarity on the time frame of the actions that RBI has taken, and also the impact come through on earnings. I am sure these businesses are going to be able to save themselves from most of the damage. But if this is going to be a slightly longer term event, which is more than 6 months, then the balance sheets and the interest margins will start showing up in terms of pressure. So wait right now. These are high quality names. I think as far as IndusInd is concerned and ING Vysya, we like both those names. But from a trading perspective, I would wait.
Okay, managing to scratch the surface at 6,000 right now, 29 points higher, and this is much unlike what the rest of the globe has been doing, because really no positive move coming into the US equities or Asian markets for that matter after Bernanke's comments. Fairly tempered, but for us, we've made a dash of about almost 0.5%, testing around that 6,000 mark. Let's see how long this actually sustains because of the kind of volatile phase that the market seems to be in. The banking pack, though, is seeing a fair amount of recovery after the slump that we saw yesterday. So it's up by about almost 0.5% for the Bank Nifty as we speak, 20,036 for the Sensex as well. TCS, that is one stock which is actually holding out ahead of its earnings. Sandeep, after the positive surprise from Infi, what is it that you're expecting to hear from TCS?
We have liked TCS. As far as the sector is concerned, I think the whole sector has tailwinds in terms of at least the rupee fall, which will help negate some of the margin pressures that the sector is facing. As far as TCS is concerned, I think there's very high confidence as far as the management is concerned and the ability to deliver. They have clearly been the leader in terms of performance and operating terms, and in terms of being able to deliver what the market expects for the last couple of quarters. So expectations are running high. Sector is favorably placed, at least as far as the rupee is concerned. So I would stay positive on TCS, given the kind of environment which we are in. At least the IT sector has cheaper valuations, and we have cash generative businesses. We have balance sheets which are in good shape. We have some headwinds in terms of operating pressure and some slowdown, but it's still a better place to be in than the rest of the market. So we would remain positive on TCS.
So Sandeep, where are you treasure hunting in this market, and where you think valuations are still attractive and growth will be reasonable?
No, I don't think this is a time for treasure hunting. I mean, I don't think that this is going to be a market where things will turn around in the next 6 months. I think this will test our patience. This will test our belief in India. So this is a market where a lot needs to play through. We have a new governor in RBI coming through before the end of this year. We have a new central banker coming through in the Fed beginning of next year. We have elections to play through, politics. We have the budget which will come through in February. So there will be multiple events which will test your conviction. So the treasure hunting has to happen when there's light at the end of the tunnel. And for some time, I think we are still in a zone where this is at least maybe 6 to 9 months away.